All right. So, I mean, the big picture is basically that we still have more stimulus coming in. The balance sheet's going to new all-time highs, where they're actually selling off some of that massive cash balance that the Trump administration made, which is effectively a new kind of QE, if you will. And money supply growth is still off the charts in uncharted record territory. 25% of all US dollars ever printed in the last year. And fiscal stimulus is off the charts. $5 trillion of fiscal stimulus in the last year, and more on the way. And so that's all sloshing into markets. So the other thing it's important to understand from a big picture basis is that we've had this huge run up in long-term rates in the United States that hasn't really occurred nearly as much anywhere else. That means the yield curve is steeper in the United States. It also makes a dollar stronger relatively. And generally, if you go back for many decades, the countries that come out of recession with the steepest yield curve tend to have the best market returns. So we're still in an environment, even though the ETFs have broken out of 13-year bases and everything, the relative strength is not doing so well right now with this dollar rally, and the yield curve in the U.S. makes it look like the U.S. is still likely to be the main market that's going to be taking advantages early phase of the recovery, especially with Europe having the COVID lockdown renewed and everything else. It's non-synchronized, which is not going to make it as powerful as it would be. And it also means that the U.S. is likely to be sort of out benefiting. So the U.S. is still the lead market in terms of relative strength. Now, we are on some evaluation tools, we are off the charts. The question is, but we've never really had 25% a year money supply growth, and so there's still going to be a lot of liquidity sloshing into markets that'll feed this for longer, but this may truncate the durability many years out of this recovery. The other thing to understand that we really, I think, read the PSL, the on the horizon column this month. Important to understand that the ingredients of lasting substantial prosperity, wealth generation, and growth are gains in productivity. And we really, the problem is with a fiat currency that it leads to problems with creating the kind of productivity growth that you need to fuel sustained growth. And so we have we had this period where, productivity growth came down really consistently over many decades since 1971 as we started with the fiat currency. And then it got really bad in the GFC because we got to levels of debt that are sort of this Reinhardt levels that over the last 800 years, anytime a fiat currency the total debt in the country got to that level, you started seeing problems with aggregate demand. Really, what was happening is the debt is too high for the economy to be able to afford. And so that leads to problems with aggregate demand. And when aggregate demand begins to taper off, that leads companies not to invest in new capital nearly as much. So we have this problem with the fiat currency system that it leads to, at the end phases, really low capital investment, and that leads to low growth. And the point I want you to see is that we are not experiencing a capital spending boom. It's up. It's up from zero, and it's up at normal sort of recovery rates, but it's not even up to the levels that we had after the Trump's tax cuts, which were still much lower than any recovery. So the long-term, the things that create long-term growth are still not there. So we're going to have a boom in terms of GDP growth this year, whereas markets are still having tons of liquidity slosh into them, so they're going to be good, but it could be more like a FDR type recovery where there's tons of spending, tons of stimulus, and the markets do really well, but the economy is not likely to do super great in terms of growth. We are still seeing tons of liquidity flowing into the markets, and that's one reason that the markets are still doing well, and there's likely to be more coming. If you look in, this is a chart of it flows into stocks in blue in the bottom panel and bonds in green. We're still really seeing liquidity flowing into both to a certain extent. Usually there's a phase where liquidity flows out of bonds and into stocks before stocks running into big trouble. So we're still seeing a lot of liquidity flows into stocks. It's likely to continue to fuel market gains. April is one of the best months of the year over the last 50 years. Over the last 20 years, it's the best. But oftentimes it leads to sort of the end of a seasonal strong period, and when you start running into problems with the market flattening out into October, November, that sell in May situation. April's strong usually the third week of April is particularly strong. So we have a degree of divergences that we have are starting to grow, but not to the point that we'd expect an intermediate term correction yet. So we suspect that we'll get a decent April, but we're really going to be watching internals closely the next few months to see how much divergence builds, because if you compare our market to the GFC, which is this white and green line here, you can see that the correlations have been really strong. That coming out of the GFC, it was heavily QE, heavy stimulus, and we're in the same kind of situation here. And so the correlations have been really strong. And you can see that now we're getting to the point where a month or two from now, you're getting to the point where you had that first intermediate term correction. And so looking at it from a number of standpoints, there are reasons to start to be concerned about some action. So we're really going to be watching divergences closely. And then this is another reason. Usually when bull markets start, and really the two to look at are the red and the purple because they're coming out of recessions. But you can see that after that ISM pops to about 60, you start getting more rocky action. You might get some higher, but it's much rockier. And so that's really, we've just gotten to the point where the ISM is above 60 in the United States. And so it's this level where the economy is getting hot enough that it starts to be a concern growing for markets. Okay, so this is our ETF list, and what I want you to see is in purple we have sort of the early recovery themes, and now we're nearly half early recovery themes. In the kind of the orange is sort of the early phase before early recovery where the markets run, but the economy really isn't, and there still is some of those. Still have some consumer discretionary, some of the clean energy things, rare earths, lithium, some of these industrial robotics, semiconductors is still leading. Some of these are secular themes that are going to continue leading. And then in the light blue, we have some of the next phase of the cycle. And at the bottom, we have potential bases. And so these are ETFs and stocks on our list that are in potential bases. And what we like to do when we're coming off of a correction is look for breakouts in those bases in the industries and groups that we're trying to get involved in for new leaders. And we like the ones that are breaking out first. And these are the stocks, and the stocks are very similar, mostly new recovery themes, but a mix of some of the early recovery themes like semiconductors in particular, and some of the later recovery themes that are starting to appear. Next slide as well. And so those are our list of ETFs and stocks with our comments, and you got an idea where they are in the cycle, as well as the bases that are being carved there. And then the one thing to realize is that the volatility among sectors and stocks is still really high, off the charts, the same as it was in 2020, even though 2020 was the most volatile year we had in stock market since 1929. So we're still at a level of volatility among stocks, up and down, that's really at record levels close to what we were last year. And we're getting some stocks that are taking big hits and some that are doing well. So you just have to realize that a portfolio is going to have more volatility in this backdrop than it usually does. And then unsurprisingly, the stocks, the groups that tended to do well for this phase of the cycle where interest rates have started to rise pretty sharply are these early cycle themes like industrials, energy, materials, and financials. Whereas the ones that were the first, the consumer discretionary and the techs that led the recovery when we were still in lockdown have been the weakest. Also realize that it looks like financials probably still have room to go to catch up to the degree of long-term rate rises that we've seen. Now, we're coming out of a correction potentially, so you will be watching for the early breakouts, and we have some old themes, sort of older cycle themes that are still leading. You can still go with those. Google is an example of an early leader just breaking out, Friday, and you still have analysts suggesting that there's 50% upside in Google. Also, we have semiconductors. If you look on our list, they're filled with semiconductors. There's a lot of them. Semiconductors have broken out of a base this weekend, breaking out in OBV, and there's quite a lot of plurality in the group. So even though this is a sector that often does well earlier in the recovery, semiconductors often can do well prolonged throughout the recovery. So I think you still want some semiconductor exposure.